Good afternoon, everyone, and thank you for joining us today for our third quarter webinar. I'm Ryan Bouchey. I'm joined today by Marty Shields and David Rath, and we're going to give an overview of current economic landscape, a little bit of what the trade wars have impacted the United States and the rest of the world, as well as some positives that we're seeing in the current economic environment. So let's jump right into it. Here we have, I think this is a great indicator of what our current market cycle has been about. A lot of the up and down days, especially the volatility, seems to be driven by the headlines. Here we have impeachment, you have the bull looking worried, the bear piquing its interest, and you have it with whether it's been impeachment talks, whether it's been the Federal Reserve, whether it's been some of the news that comes out about the trade war. You see a lot of intraday volatility based on these headlines. We always tell clients we're never trading on these headlines. We'll get into a little bit of what the trade war and how it's impacted us. That's a bigger thing, but in terms of the day-to-day headlines, never something we want to solely focus on. So the third quarter, pretty flat for the most part in the U.S. indices, all the U.S. major indices, the S&P, the Dow were up about 1%. The Nasdaq was just under. Flatline was just down 0.09%. So again, relatively flat. You see a lot of these ups and downs in the chart. Again, a lot of that was driven by I think a lot of it was the news cycle. Here we have a recap of the third quarter, year to date in 2018. You can see just the volatility that we've seen in the last 20 months or so. We've had 2018 was really a down year driven by the fourth quarter. Year to date, S&P up a little over 20%, but 18% or so of that gain was happened by about mid-April. So since that point, the last 6 months or so, we really haven't seen much of a rise in the markets. And again, it's a lot of this volatility and these points that we're just not able to break through. Our portfolio positions as of right now, not much has changed since our last webinar last quarter. We continue to be overweight U.S. equities, the technology sector, which has really helped us so far, financials, which have gotten a little bit of a boost lately, healthcare, which is a little bit more of a defensive sector holding, hasn't been as great so far year to date, but we're still holding on. In dividend, you could also say value-oriented stocks, ones that maybe more blue chip in nature and would hold up better in volatility, periods of volatility. We continue to be underweight international equities. And David will go into later this presentation, but we've gotten out of some of our more high volatility growth positions that we held earlier in the year. So let's talk a little bit about what the trade war and how that has impacted both the U.S. economy and the global economy. I think this cartoon speaks to our position last year and kind of what we're seeing happen so far this year is that, last year when you look at the impact of our trade with China, how much of our GDP is driven by exports to China, it was very low. We really didn't see it having much of an impact. And I think we all kind of thought that it would get solved sooner than later. But, as we get into further and further through this year, remember, trade war started in January of 2018. We're seeing more and more impact on not only our economy, but also the global economy as this continues to go on. So here's a good chart just showing this red line here of when the trade wars began. This was January 2018. And essentially from that point forward, we have not in the last 20 or so months been able to really surpass that point that we hit. You see throughout the year, both last year and this year, we keep hitting resistance as we get back to that point. And again, I don't know if it's going to take these tariffs and this trade war to get solved to break through it. It's also important to note that this is the MSCI World Index. So this is all global equities, both U.S. and international in this chart. But if you looked at the U.S. equity chart, it would look pretty similar in that time since last January. This is great to remember. I think has been headlines lately of a global recession, and this chart just goes back. I circled in red here, 2008. So we saw, this was a global recession in gray here. U.S. was in a recession at the same time, but since that point, we've actually are now in our third global recession. These gray bars, so 2012, 2016, and again right now in 2019. And the important thing to remember is that just because we're in a global recession doesn't mean the U.S. has to be in a recession. We saw it in 2012, 2016, where, especially in 2016, China was slowing. The price of oil was dropping, had a big impact overseas. And the global economy was really in a slowdown. And even though we had volatility during that time, the U.S. didn't see a recession. So when you do hear and see headlines about a global recession, again, it doesn't necessarily mean that the U.S. needs to go into one as well. I always love using these heat maps just to kind of see where the world economy is going from a manufacturing perspective. And what this measures is the Global Purchasing Managers Index. Essentially, if it's above 50, it means that manufacturing is growing. If it's below 50, it means that it is slowing down. And for the most part, heading into 2019, we are seeing a slowdown in global manufacturing right now. I also circled 2012 here because the trend looks very similar to that. And the important thing to remember again is that we could see a global slowdown. Again, it doesn't necessarily mean that we have to go into recession, but it's important to note that not only is global manufacturing slowing, but as U.S. manufacturing is slowing down as well. Why is this global trade? How does it impact U.S. companies? We've said we're a little bit more insulated than the rest of the world, but when you look at the S&P 500 and where these companies derive their sales, only about 52% is made up in the U.S. The rest, almost 50%, about 48% of sales are made up overseas. And that's a huge, huge number. And that's why, what's going on in the global economy can have potential impact on our U.S. markets and our U.S. companies. Let's look at world trade in general. So this goes back about 25 years. The average growth on a world trade volume is about 5%. Just recently, we went below that. We're actually in negative territory. So trade is slowing. And again, just like to point out that the last two times that we've seen negative trade volume was back in 2000 and 2008, 2009. So it's important to watch this. Hopefully, again, weighing whether or not this is driven more by just overall global slowdown or if it's driven more by what's going on in the trade wars. And if we get this trade issues resolved with China, could we see a bounce back from this? It's very possible. So we'll continue to watch this very closely. Trade uncertainty is hurting business investment. For our economy to continue to grow, we need these large corporations to continue to invest in their businesses. And I want to focus on the right side of this slide. In 2008, growth in business investment was about over 6%. This year, it's about 3%. Next year's forecast is under 2%. And why that's so important is you see this red arrow on the right side. It's pointing to the tariffs and trade uncertainty. That has been a big drag on the forecast for business investment. And again, if this trade uncertainty carries on, we could see a slowdown here. If we can get that resolved, it could be definitely a positive for our U.S. corporations. I love this slide showing how the impact of these different countries, how much exports are as a share of their GDP. And you see the top part of this graph, a lot of emerging market countries. A lot of these countries derive most of their GDP from exports. They're manufacturing companies. They're relying on global sales. The U.S. circled here is the least impacted by exports. Only 8% of our GDP is made up of our exports. So again, in the grand scheme of things, we are going to be impacted less than other countries. But at the same time, we are seeing an impact here. So this shows the blue line, new exports orders. The red line just shows that manufacturing PMI composite index that I talked a little bit about in that heat map. And you're seeing that blue line right now really, really plunging, even more so than in 2016, which was the last time we really saw a global slowdown. And again, this is affecting and being the consequence of the trade war. And so, you see manufacturing, again, kind of ride this same path. And so until we get this trade war solved, I think we may continue to see some slowdown in manufacturing. And with that, I want to turn it over to Marty Shields, who's going to get into a little bit of the U.S. economic landscape.
Thanks, Ryan. Good afternoon, everyone. As Ryan mentioned, I'm going to talk about some of the challenges we're seeing from an economic perspective. But before I go in the slides, I really want to stress that there's a lot of great things that we're still seeing in the economy. and my colleague David Rath will discuss those. But we think it's prudent that in 10 years into this bull market and economic cycle that we're cognizant of some of the challenges. And the big element with this is, what is the trend of those challenges? So is it just a data point or two that drops down and shows some weakness, or is it more a consistent trend that we're seeing that could be indicative of more weakness to come? So this slide is just to show you that we're looking at a lot of different data points as we're looking at some of these challenges, and we're weighing the strengths versus the weakness. With the U.S. economy and all the data points, there's a lot of things that we're looking at, and as a change occurs, and if there's any kind of continued weakness, it doesn't happen on a dime. It's going to happen over many months or even many years. So again, just trying to illustrate that there's a lot of things that we're weighing as we're making our decisions to where the current market and U.S. economy stands. I think this graph is really important, is to kind of understand where corporations stand from their outlook on the economy and what their plans are for investing in their businesses. So this blue line is the confidence of CEOs, and the light pink bars that you see are recessionary periods. And what you'll see is that the CEO confidence level declines before many of these recessionary periods. And we have seen a decline in the last year and a half. And a large part, that is driven in large part by the tariff issue. You can imagine that with all the tariff discussions that are going around globally, in particular with China, if you're a CEO of a large company, you're going to be a little bit concerned about investing any large amounts in capital investments until some of that situation gets clarified. So that sharp decline is definitely going to be something that limits some of the capital that large companies are going to be willing to spend in the economy and in their business. I think this is a good chart. It basically looks at uncertainty in the economy and capital spending that occurs. So as uncertainty improves, or there's less uncertainty, which is on the top part of this chart, you actually see the gray bar, which is capital spending, increase. And then as uncertainty increases, you see the gray bar decline, so capital spending decline. And just want to highlight, you can see this in 08 and 09, where uncertainty really increased dramatically, and as well capital spending followed that. But we also saw this in 2011, 2012, where uncertainty increased, capital spending declined, but it came back. And also in 2015 and 16, where uncertainty increased and capital spending declined, but also came back. So the question is this decline that we're seeing here now temporary, or is something that's going to be more significant as we go forward? So we've talked about this before, the importance of corporate earnings, both now and future corporate earnings. That really is the primary driver behind the stock market performance in the long term. And looking over the past 4 or 5 years, you can see that in 2015 and 16, profits were negative. So this is year-over-year change of corporate profits. And in that time period, it was driven by the energy sector really kind of imploding with a sharp decline in oil prices. And then an increase in year-over-year profits in 2017, and then again in 2018. In 2018, those large increases were driven primarily by the tax reform bill of 2017. And then you can see in 2019, we've had a decline in profits year over year. And relatively speaking, actually, we've had some surprises on the upside relative versus what the forecast was for profits. But in order for the market to continue to go up, we're really going to need to see profits increase year over year for the upcoming quarters in 2020. As we've talked about the importance of the labor markets and the consumer sector in the general economy, what we're seeing in the last few months is more jobs being added, but below what we've seen in the last 4 or 5 years. So what this chart shows you is that since 2015, the amount of jobs that are added on a monthly basis can vary dramatically. But in general, it's been somewhere between 150 to 200,000 plus jobs, whereas more recently, it's been more 150 to 100,000. So again, the question is this a temporary decline in the number of jobs added, or is this more of a trend that we're going to continue to see where those jobs numbers maybe goes to 100,000 or below? I think this chart is really interesting, kind of gives you a good idea where we stand from an economic perspective. It looks at the unemployment rate, which is the gray line, and then it compares it to the wage growth in the economy, which is the blue line. And what you see is, from a historical perspective, when those two lines either get very close like they did in 87 and 89, or they actually touch like they did in 99 and almost in 2006, those were time periods right before a recessionary period. So more recently, in August, the unemployment rate was at 3.7%. In September, it actually dropped down to 3.5%, and wage growth was at 3.5%. So again, these situations where these two metrics get very close or actually come together are quite often indicative of an upcoming recessionary period. And this basically looks at the Michigan Consumer Sentiment less the Conference Board index. And what you see as the spread between these two metrics gets very close, from a historical perspective, that was also, it happens quite frequently before a recessionary period. Right now, we're at a very low period versus other time situations. And again, it could be a situation that we're getting close to a recessionary period. I think this chart is a great, gives you a great visual of where we stand when we're talking about leading economic indicators. So the blue line is year over year change in economic indicators. And what you see is that in 2011 and 12, those economic indicators still had positive change, but they were starting to flatten out. But then things started to improve in 13 and 14. Again, in 2015 and 16, there was positive change in year over year for economic indicators, but it was starting to plateau out. And again, we're starting to see that same situation happen now. So the real question, and what we'll be closely watching, is, do they actually go negative? In which case, you can see from a historical perspective, when there's actually negative change in those economic indicators, quite often a recession follows, or will we kind of have a bounce back up like we did in the last two periods? All right, now my colleague David Rath will be here to talk to you about some of the positive things we see in the economy.
Thank you, Marty, and thank you everybody for signing on today. As he mentioned, we're going to go through some of the signs that we still see for growth potential within the economy. And I think the focus is really going to be, at least at the outset, on the American consumer. Right now, the consumer debt levels that we're seeing are stable. We're not seeing an increase where people are overreaching with their pocketbooks and taking out the loans to finance some of the spending that they're doing. As we mentioned on a previous quarterly webinar, the service levels for the debt are somewhat low due to the fact that there's lower interest rates in this current environment. So again, the overall outlook for debt levels in the consumer is somewhat healthy. And the consumer spending continues to grow. As you can see, preceding the last two recessions, before the recession, the consumer spending somewhat flatlined before going into a decrease within the recession. We still are seeing the spending trends continuing to go up, which is always a good sign for the economy. And this chart highlights how important the U.S. consumer is to not only the U.S. economy, but the global economy. You can see they even outpaced the entire China GDP, which is somewhat surprising, but it just illustrates again how big the U.S. consumer is to the overall health of the economy. And the preceding two slides show that they're still in a good spot. One of the preeminent leading indicators in the economy is the jobless claims. And as you can see, preceding each of the last 7 or so recessions, the jobless claims have bottomed with a few months lag time before the recession actually starts. With our current trend, it's still a downward trend, which is, again, a good sign because there's not people that are actively looking for work. People are continuing to hold on to their jobs and they're not having to go to the unemployment line. Another leading indicator is the prevalence of the new home sales and the trend that exists within that. As you can see, the trend is still on an upward slope, especially preceding the last recession. There was a sharp decline in the number of the number of new homes being sold. And preceding pretty much every other recession, there's usually a spike that precedes the decline into the recessionary period. The service sector is still expanding. Just as a quick refresher, any reading above 50 is showing a sign of expansion. And the chart is somewhat noisy, so you can see some ups and downs in the short term, but overall, that indicator is staying above that key 50 point level. Now, the expectation is for a rate cut at the end of the month within the Federal Reserve. Again, this is a good sign from the standpoint of the Fed's getting out in front of any sort of recessionary pressure. So some of the things that Marty had mentioned before, the Federal Reserve is viewing the same data points that we are, and they control the monetary policy that can potentially get in front of some of those recessionary pressures by making it easier for businesses and banks to lend on a short-term basis. This is one of my favorite charts because it's showing the difference between the 10-year yield on a government bond and the dividend yield on the S&P 500. And very rarely does the dividend yield go above the yield on a government bond. And when it does, we think that it's a positive for stocks because not only are you getting paid the dividends from the corporations, but you're also getting the potential for future growth within those corporations. So as you can see, it's only happened a few times in the last couple of years. Over history, it's almost been non-existent just because of where interest rates were. But again, if we're checking off boxes, this is definitely one that goes in the positive. Now, the big question is, what does this mean for the portfolio? And obviously, that's the big question for us as a firm, and how we incorporate the views that we've just discussed into how we manage the portfolio. I'd like to lead off with a little bit of a cartoon showing some of the drawbacks to making an all-in or an all-out decision based on one data point or one projection. As you can see, the fellow on the left, he had probably moved his portfolio in such a way to benefit from rising interest rates, or at least to prevent the damage from rising interest rates. And I think everybody has been talking about entering a rising interest rate environment for the last couple of years. Again, we're not sure where that's going to go, but we're not also going to make a binary decision on the portfolio based on a projection like that. A little housekeeping first. I know I sent out the email regarding our zero commission trade policy, or Schwab's zero commission trade policy. Just want to reiterate how good of a development that is for our clients. Schwab was the first of the major custodians to announce the change, and we believe it is an unequivocal win for our clients. Anytime you can lower the cost and lower the friction on a portfolio, it's a good thing. And I also want to make sure that everybody understands that it does not matter whether you have the e-statements or if you have paper delivery. It doesn't matter. You're still going to get the $0 on any sort of ETF or equity trade. Now, I want to go back in time and look at some of the changes that we made in February and almost look at what the score has been since then. So in February, what we did is we waited for the rebound in the equity markets because, again, we don't want to make any sort of rash emotional decisions. So we waited for the equity markets to rebound, and then we made some changes on the margins of the portfolio. And some of the more speculative, more growthier types investments, like your biotechnology and the small banks, we moved them into a more stable dividend-paying ETF. And as you can see, the red line represents that iShares high dividend yield ETF. And the performance since then, I think this is a clear win for our clients because we saw the changes that were occurring and we acted on it. And this leads into the next slide, where we talk about how we're going to incorporate the previous economic slides into what we're going to do moving forward. So to summarize what we talked about today, there's there's things on both sides of the ledger, both good and bad when it comes to the economy. The economy is a slowly shifting mechanism, so we always want to make changes at the margins of the portfolio. We're never going to make an all-in or an all-out call. However, we are working on some developments within the portfolio that will slightly shift the portfolio to somewhat of a more defensive posture to prepare the portfolio for what we see coming down the road. But I want to reiterate that it is not us running for the hills. It's not us forecasting a recession in the next month. I hope you took away from my section that we still see some very positive signs for the economy, but we are going to start shifting the portfolio into one that we are comfortable with to ride out any sort of turbulence that we might see in the future. So once those changes are made, of course, we're going to communicate those changes with the clients. And if you have any questions, feel free to give us a call. Feel free to give me a call or any of us here at the firm. And with that, we will conclude the quarterly webinar.